So Canadian mortgage companies, banks specifically, are using inflated property values to back mortgages that they know are underwater. And the regulator says it's fine, nothing to see here. There's a word for using fake asset values to sell loans to investors, but it escapes me right now. Maybe it's I don't know, something like that. Either way, there's something big going on right now, and I want to understand why this seems to be okay in the marketplace. So, pop quiz: what do you call it when you use an inflated asset value to back loans that you sell to investors? Fraud. We call it fraud, textbook fraud. Yet in Canada, we call it something called blanket appraisals. And our banking regulator knows it's happening. And they even acknowledge the mismatch between appraisal values and actual market values. Their response is crazy. They said it's only 1.4 mortgages nationally. So we're cool with it. Not a big deal. This is according to OSFI's report in February of 2025. And that's based on newly completed condos as a share of all mortgages. But what's even more insane is that 23% of these mortgage dollars are actually just in Toronto, the epicenter of Canada, which had 45% of the condo completions in the entire country up to the last 12 months, up to September 2025. Just nuts. Now, I'm not even a Toronto centric podcast, but it's kind of a big deal. Let's talk about the national considerations. Look at that. So when they say 1.4% nationally, they're hiding the fact that, again, in the quote unquote epicenter, Toronto in this case, and don't forget Vancouver is very much a part of this, which has 23% of all of Canada's mortgage debt, is about to see 92,000 new mortgages based on quote unquote fake values. And this is not a 1.4% problem. That's a Toronto problem that's disguised as a national statistic. So let's break down how this whole thing works, because I don't think a lot of people actually fully understand why this is a big deal and how it works. So to understand why this is insane, you need to understand how the pre-construction condo home buying normally works. So step one, you don't buy a home, you buy essentially a contract, which is the right to purchase a home when it's complete. Number two is the building itself takes somewhere typically between 3 to 5 years longer when the demand slows down. You make payments, a deposit typically of 15 to 20% of the market value. At the time that you purchase it, most of these companies don't require a specific mortgage approval. Sometimes they do, but normally they don't. When the unit is finished completion, the time to close, that's when you take possession of the property. At that time, you need to come up with the remainder of the 80% or 85% market value of your property. This is when you get a mortgage and you can take over. So what happens typically is when you are up for completion, the lender you're working with is going to ask for what's called an as complete value appraisal. And that's essentially where they determine the current market value of this property relative to other properties in the area, factoring in it's brand new, never lived in, these types of things. And typically speaking, a bank will lend up to 80% of the market value unless it's insured, in which case they'll lend up to 95% of the market value. So you need somewhere between 5 to 20% equity in the problem. So what happens when we see 2022 to today where prices fall? Well, in an example scenario, you buy the home for 800 grand in 2021, you buy the contract, the market drops 30%. Now the value is $560,000. Now the bank says, well, we're going to lend you 80% of $560,000. That's $448,000. Your deposit was, let's say, 120. You've got this big fat shortfall that you got to come up with right now, and that is $232,000. And you can't just close unless you come up with the cash. And this is actually what we're seeing that started happening in most major cities, whether it's outside of GTA, outside of GVA, Lower Mainland, and other cities in these major markets since basically 2023. It got worse in 24 and even more so in 2025. So here's the thing. There is a quote unquote magic trick. Instead of appraising each unit based on the current market value, some major banks offered something called a blanket appraisal. Now, this isn't in all properties, it's not in all situations, but they started offering these blanket appraisals, which was the entire value for the whole building using the contract price as value, which is kind of crazy. So they take the original value contract, say it's 800, even though the current market value is 560, they give a blanket appraisal at $800,000, which means your mortgage is approved at the inflated value. Now, that's basically them pretending it's worth what someone paid a couple of years ago. And listen, I'm not against. I don't think people is a good thing for people to have to come up with a whole bunch of money and have a shortfall in a deposit. But I also don't think it's a good thing to use a stale peak price to approve a mortgage on an asset that's worth significantly less. Like that's a bad idea in my opinion. It's like buying a stock for $100, watching it drop to 60, and then your stockbroker saying, "Don't worry, we'll use $100 for your margin loan." Now here's the kicker. OSFI, which is Canada's banking regulator, they're on fire these days, put out a statement acknowledging the mismatch between the blanket appraisal and a proper survey appraisal and property values. At the time the mortgage closed, they said they flagged it as a concern of mismatch in timing. They worried about inflating values and asset values and amplifying lender losses if the collateral doesn't exist. Then they did nothing, which kind of translates into, we know you're using fake values to back loans, but we're going to pretend it's not a big deal. So OSFI's 1.4% estimate, it's based on newly completed condo apartments as a share of all mortgages nationally, not just pre-sales. So basically looking at Toronto mortgages, condos compared to farms in Saskatchewan, detached homes in Calgary, bungalows in Halifax, the whole friggin' thing, which is nuts. And if, again, I'm going to talk Toronto-centric only because they're the ones who have the biggest share of properties right now in Canada that are these pre-sale condos. There's a lot in Vancouver and surrounding cities too, but just for the sake of conversation, these are the stats that are easy. But Toronto has 23% of all mortgage dollars in Canada. They've got 45% of all condo completions in the last 12 months to September 2025. 60% of TREBB sales, which is the total sales recognized. And if Toronto's completions were a real estate board, they'd rank third in the entire country, which is massive, an insane concentration in one single market. So this was the market that led the boom, and this is the same market that's leading the bust. Now, I'm going to get into too many more numbers as far as that's concerned, but what you need to know is that they've got 91,000 more units under construction, with the peak in June of 2023, which is still very elevated. And each of these properties is most likely overvalued and is going to require a mortgage. There is a serious price gap here between the resale condo prices versus the brand new prices. As we've talked about, peak buyers have come down 30 plus to 40% off peak. So if you bought a pre-construction condo in 21 and you compared the resale condo today, they're selling for 300. So if you bought it for 800K, it's selling for like $300,000 less. You're not just underwater. You're in the freaking trenches. And so the question everybody's asking is like about these blanket appraisals, like why is this happening now? And the reason for this is because all those peak purchases are completing. And the low rate boom was in 2020, 2021. Construction takes 3 to 5 years. This is where we're at. But again, the bigger thought process is like the official story is that these are actually helping first-time home buyers and other people avoid from losing their deposits, which is very sympathetic, right? Sounds reasonable, except for that's not who's buying these units. Most of these units, 70% of them, these condos, whether it be in Toronto or Vancouver or other areas, are investors. And I'm not trying to say we should punish investors, but the problem here is most of them never planned to close. They expected to flip assignments. They're now holding on to cash flow negative properties. Most of them owe more than it's worth, and they can't sell without taking a massive loss. And unless 4 to 5 of these investors who recently took possession were planning to be cash flow negative, losing equity, this probably wasn't the plan. So, and like, here's the thought, again, just exposing this. Here's how we know this is really about investors, not first-time buyers. When the government announced 30-year amortizations for first-time buyers, they quietly extended it for everyone just days later. I think the key to this here is like, again, who's benefiting from this and what's the thought process? Because it's not the buyers. Like, it definitely isn't the buyers in this case. And it's not even the investors, because the investors are losing money. The real win in this scenario is actually the developers. Now, this isn't to be said that developers are bad guys. I don't want to go down that rant, that road right here. But the truth is the investors, the developers are the ones who get paid in full at closing. They risk transfers from the developer over to the buyer. The developer exits before any price discovery even happens, and the buyer in this case is left holding the bag. Again, also don't think that these mom and pop investors are innocent, but these developers are basically like the sharks surrounding these little fish. Institutional lenders who fund these projects are basically like the big old orcas, and they're just all eating each other up. The blanket appraisals convince everyone that the bottom person, in this case, the person who bought the assignment contract, is the bad guy here. So basically, all of this comes back to one thing, which is to protecting the developers against from default risk, which is like close the deal, transfer the risk to the buyers, and then use better tools to extract the debt at a later time. So here's the thing. There is a nightmare scenario for people. You bought a house in 2021, you bought it for $800,000, and the unit completes in 2024, and you can't close. So what happens? If you can't close on that property, you breach the contract, you lose your entire deposit. The developer can sue you for a shortfall if they can't sell it for the same. They can sue you for the legal costs. You're liable for carrying costs during litigation. So everything. So you lose your deposit and you get sued. And then the developer probably just resells your unit in the end, probably for less in this market, and then comes after you for the difference in costs. Now, a developer, they've got cash. Listen, they can easily pursue one or two buyers that breach, but when you have an entire building, 30%, 40%, that becomes a serious resource problem. So if you think about like a 500 unit condo building, 150 buyers say, I can't close on this thing. Well, we've got a serious problem. That's a resource problem here. They can't pursue 150 separate lawsuits, and they would rather probably close deals at inflated values. So the blanket appraisals here are solving a major problem. But here's again where the system in Canada gets real predatory. Everyone talks about foreclosures, but foreclosures are rare in Canada. And this is because Canadian lenders, they have a better tool, and this is called the power of sale. So if you don't know this, there's a difference between power of sale versus foreclosure. Foreclosure, the lender takes title of the property, sells the property, and that's it. Okay? Power of sale, the lender sells the property without taking title. So the lender can pursue the borrower for any shortfall indefinitely. There are no limitations in all of these provinces. So basically, you take the underwater mortgage through a blanket appraisal. You try to tough it out as a cash flow negative landlord. You finally give up after 2 years of bleeding money. The bank just sells your unit for $600,000 when you owe $640,000, and now the bank can chase you for the $40,000 shortfall unit cost forever. Like it's nuts. It's nuts. Like essentially evil, if you want to put it that way. And that's why I think that we've seen this surge in power of sale listings in Toronto. Like the banks don't need the foreclosures. They've got this weapon that they can go forward with. So if there's something you need to think about, that's it. Now, I'm not a big doomsayer here. I've had some people online call me a FOMO pumper or something. I don't understand that. I try to be pretty much in the middle, and I try to just explain the downsides and the upsides. So not everybody thinks this is rosy, but not everybody thinks it's bad. It's the truth. But there's a lesson from the 2008 U.S. financial crisis that everyone in banking remembers. Deep-pocketed investors use bankruptcy as a tool. Normal people tried to pay their bills. So 2008 dynamic, institutional investors walked away strategically. Big guys walked away strategically. Individuals, they tried to pay even through negative equity. The fear of default or bankruptcy kept the households actually paying off many of these debts. And the banks learned that retail borrowers are safer than the institutional ones. So from a financial system standpoint, the biggest risk isn't mom and pop investor with less capital. The biggest risk is the party most likely to cause the single largest point of failure, the developer. So the strategy for them is the developer faces completion risk. If a buyer can't close, the developer holds the unsold property. Developers have the leverage to walk away. Blanket appraisals enable the ability to close on the property. The risk then transfers from the developer to the buyer, in this case right here. Small buyers, less likely to default at this point right now. And if they do, the losses are pretty manageable. They're not crazy. This is literally the U.S. housing bubble playbook here. Crazy. Policymakers there, they thought that young adults would ride out the losses longer than institutional investors, so they facilitated the risk transfer. And in Canada, what makes this even worse is there's no foreclosure protection, power of sale. There is no statute of limitations on debt collection, and no discharge of mortgage debt in bankruptcy in some cases. There's a stronger legal tool for lenders here in Canada, which basically says U.S. lenders in 2008 would have killed for Canada's legal framework. You can't discharge a mortgage through bankruptcy in many cases, the bank can chase you forever. It's a collector's paradise in Canada. They love it. So here's the detail that's almost too dark to be funny. In 2022 to 2023, there was a massive spike in suspected arson of new condo buildings and construction in Toronto. Yeah, buildings were like, if you can remember this, buildings would mysteriously catch on fire right before completion. And no, we're not asking for that to come again. But here's the thing. If the building burns down, you do not have to close. No completion, no closing, no need to secure financing. In 2022 to 2023, we saw arsons go up, and then the market peak was in early 2022. Completion started in 2023, and the surge of all these blanket appraisals has started coming in 2023, with the arson kind of like tapering off in 2024 and 2025. It's kind of nuts, actually, if you think about it. On the upside, the suspected or like thought after arson fires of new homes under construction has tapered down with the rise of blanket appraisals. I don't think the timing here is a coincidence. And so the thought process is, did the blanket appraisals fix the arson problem? Maybe. By giving people a way out, instead of burning down just the building, you can use you just use fake appraisals to close the deal and transfer the risk. So here's the thing. Like, all this to be said, what does this mean for you? If you're a pre-construction borrower and you're trying to close, you're probably underwater already anyways. Blanket, unless you bought like in 2020, blanket appraisals let you close, but they don't fix the problem. You're taking on negative equity day one that you're buying this property, and your exit options are pretty limited and they're pretty expensive. So you've got four options. Number one, you can close and hold. Only if you can hold on for 5 to 8 years in negative cash flow. That's the timeline that BMO is represented as their target. Now, it could be quicker, but that's what I would recommend mentally thinking of. You can negotiate with the developer. Some units are taking them back at a loss, and they'll be willing. You can give up a portion of your deposit. You can consult with a lawyer, make sure that you're okay with the legal consequences versus the closing costs. But you should not assume any appreciation. The market has a 5 to 8 year correction according to BMO. It could be less. Let's be honest. It could be less, 3 to 5 years, but be there for the worst case scenario. And if you're someone who's already closed, the math basically says day one, you're underwater on your mortgage, your negative cash flow, your exit means you're guaranteeing a loss, and your power of sale risk is there if you stop paying. So your strategy that you should probably consider in this case is to calculate the total cost of holding versus the default. Like, you can calculate over 12 months, what is the cost of me holding this property versus the strategic default, assuming you've talked to a lawyer. Understand the POS, power of sale consequences. Ask yourself the question, will the market recover before I run out of money? Talk to an insolvency lawyer, anybody. And if you're somebody who's considering buying a pre-construction, I mean, I'm not going to say don't, but be very wary of what city and what type of product. You're buying at a developer's potentially already inflated price, although I'm not going to say that they're all overinflated. I've actually seen some incredibly good value deals, so I will put a pin in that part right there. But I would definitely be conscious and careful and cautious what you're buying, and make sure to be future valuing based on everything I just said right here. If you're an existing homeowner, the risk, of course, for you is that the blanket appraisal is created kind of like a false price floor, and the market won't properly come up to figure out what those prices are, which means it ends up taking longer for the correction. And then we've got thousands and thousands of more inventory coming, which means the comparables aren't even real, and nobody sells and nobody buys. It just sits there. So if the new builds are priced via a blanket appraisal and the resale market is separate and lower, and your property value is closer to the resale comps, it's just everything is just, it's just going to be a mess. So here's my thoughts. Let's bring this all together here. Let's bring this back to square one. There are, in my opinion, three things that make this seriously wrong. Number one, the regulator knows, OSFI knows about this, and they do literally nothing. They acknowledged it. They said they're going to downplay the stats, which are all bullshit, and they enabled a systematic risk. It's a serious problem, and for no one else to recognize this is insane. I've only seen it published in one article, and it should be more places. Number two, I think it's actually predatory. Some people look at it as good that you can close on a property. I'm not saying it's bad or good for everyone, but it is predatory. It protects developers more than anything, and it transfers the risk to the borrower. It uses legal tools like power of sale and deliberately targets parties like that are least able to fund and hold that money. And in the end, I think it creates a serious risk in the overall system. There are thousands of mortgages that are being backed by inflated values. They're being securitized, sold to investors, and there's no price discovery happening. We don't know what the real price of these properties actually is. Plus we got a crazy amount of completions coming up in Toronto. So what this means for the future is that we've got more completions happening in the next 2 years. We've got more blanket appraisals that are going to happen no matter what. More investors are going to bleed cash flow, and the power of sale listings are going to continue to rise. It's just going to take more time for the market to correct in those cities, not in all cities, but in those cities that we're seeing this happen. And the crazy part is this could have been avoided if the price had been allowed to adjust more naturally in 22 and 23. We'd have a sharper correction, but a faster recovery. But these blanket appraisals are kind of propping up fake values and pushing out the return. So what you need to understand is that the idea of blanket appraisals, although it might help the odd person, and just so I'd let you all know, not everybody can get a blanket appraisal. Not every building can be blanket appraised. But for those who are, it's not actually preventing a crisis. They're managing the crisis by transferring the losses from the developers to the end users, who would basically be the ones that are going to get hurt the most. Basically using fake values to back real loans, which is going to have a negative consequence on the housing market. In the end, the Canadian housing market isn't having an honest correction. It's having a managed decline where the regulators are actively facilitating a fraud transfer from sophisticated parties who sell these units to retail buyers, the mom and pops, so to speak. With September's 92,000 homes under construction in one city, that's 92,000 more opportunities for the scam to play out. And the response is that it's only 1.4% nationally until it isn't. If you have a pre-sale property coming up in the next 3 to 6 months and you don't want to go through a bank or are worried about what this appraisal value will do for your property, click the link below. I'm happy to see if we can help you out. And if you enjoyed this podcast episode, give me a thumbs up, share, and tag me on Instagram as The Mortgage Pug. I'll see you on the next one.